Yep, and welcome back to the show. I'm your host, Lance Roberts, of course, as we were just talking about. Dr. Robert Shiller, of course, he is the famed professor who came out with the whole issue on looking at long-term valuations in the market. You know, the famed Shiller, what they call the cyclically adjusted PE ratio, which is a 10-year average of earnings divided by the price of divided into the price of the markets to smooth out what happens on yearly changes to valuations. Of course, when we go back through history and look, every time this CAPE ratio was really kind of above a level of 23 times earnings going into the 1980s, that had pretty much marked the peak of the market cycle at that time, whether it was 1929 or 1965. 23 times earnings was kind of the de facto level of overvaluation. Now, I actually wrote an article on the website today talking about, have valuations been shifted permanently higher? See, we had this very strange anomaly that occurred in the markets in 1980 and 1990. And if you go back and look at the trend of overall prices in the markets and what happened, there was this upward shift in the prices of the markets and how markets reacted 1980 and 1990 going into 2000. And valuation subsequently went so high. We went to 44 times earnings in 2000 with the tech bubble that it skewed the underlying long-term average of PE ratios. And because of that skew, everybody now assumes that we now have a permanently higher level of valuation. So in other words, we're not ever going to correct back to 6, 7, or 8 times earnings. What's going to happen is that we may correct back to the long-term average of, say, 15 or 16, and that's going to be the bottom. And that's a very risky bet to make, considering that lower rates of economic growth, lower rates of inflation are historically proven to reduce valuations over time. And what we've had since 1980 is this continuing decline of economic growth and inflationary pressures, and now we're residing at a very low rate that is likely to remain with us for decades to come. In fact, even the Federal Reserve currently expects that the long-term run rate on economic growth will be about 2%. And that has a lot of implications to overall market valuations as well as to overall market returns, because historically speaking, when we go back and look back through history, we say, well, what did GDP grow at? GDP grew at 6%. What did earnings per share grow at? Roughly 6%. What was capital appreciation on stocks? Roughly about 6%. And that makes total sense because companies, which make up the stock market, are a function of the economy, not vice versa. The economy is not a function of the stock market, right? The stock market's going up 18% a year. The economy's not growing at 18% a year. The economy grows at about the rate of population growth plus wages and inflation. So that's where you get your 6% going back historically, because people have to buy stuff. And since people buy stuff from the companies that manufacture it, it's not surprising that historically, well, you see corporate earnings as well as stock prices basically mirror the growth of the economy. Now, there are times that there is a deviation from that trend of growth, and that's perfectly understandable. It has a lot to do with psychology and behavior, et cetera. And there are times that during major bull markets and, well, even bear markets, prices and growth and earnings deviate from the actual economy. But ultimately, at the end of the day, over the long term, growth is going to reflect the economy. Okay, now having said that, if the economy is expected, as the Federal Reserve suggests, again, this isn't me, Federal Reserve, suggests that the long-term run rate on the economy is about 2%, which means that the long-term run rate on interest rates is going to be about 2.5%, and the long-term run rate on inflation is going to be about 2%. So when we want to calculate expected rates of return for stocks over the long term, inflation plus economic growth is about 4%. So all of a sudden, if you're banking, that should wake you up for a second, because if you're banking on 6 and 7 and 8% rates of return in order to meet your retirement goals, you may be disappointed. And this is an interesting situation because here we are back at levels in terms of valuation that have only been seen one other time in history. We're at 33 times earnings. The peak of all bull markets was 44 times earnings, and that was due to the fact that we had a whole explosion in the internet back in 1990 and, early 2000. And so this one-time anomalous shift in valuations has theoretically shifted everybody's perspective higher. But in reality, that's not likely to always be the case. In fact, we're likely to see a long-term shift lower in valuations. Ultimately, if it is true, and the Fed is correct, that economic growth is going to remain sluggish for a long period of time. And there's a lot of evidence for that. We've got a maturing economy. We've got massive levels of debt, which erode economic growth. So there's a lot of reasons to understand the consequences that are going to lead to long-term slower rates of economic growth. A lot of it has to do with structural reforms as well as demographic issues as well. But that doesn't mean in the short term that valuations can't go higher. And I thought it was interesting today that Robert Shiller, the guy who developed the whole cyclically adjusted PE ratio that is a driver for forward expected rates of return. And we talked about this before, and I don't want to get into this too deeply today. But valuations, what you pay for earnings today, the price, PE ratios are the price divided by the earnings that you're going to get. So if you pay $10 for a dollar's worth of earnings, you have a PE of 10, right? So you're paying 10 times the earnings rate. And what that suggests is that if you're paid out all the earnings a company makes at 10 times earnings, in other words, say it's a private company, so the stock price, you're not getting anything on the stock price. You invest your capital into a company. The company pays you out $1 every year. And in 10 years, you're going to get your money back. That's what a PE ratio means, effectively. How many years would it take you to recover your pro rata share of earnings based on the number of shares you own? We're currently at 33 times earnings. Historically, when earnings have exceeded 23 to 25 times earnings, forward expected rates of return, in other words, what we would expect to receive over the next 10 years to 20 years, have fallen to less than 5%, generally between 2 and 3%. At 33 times earnings, you're talking about roughly 0 to 2% over the next decade to 20 years in terms of return on your investment. As Warren Buffett once said, the price you pay today is the value that you will get, right? Price is what you pay, value is what you get. So if I pay too high of a price for something today, I'm going to have a low return on it over the long term. That's all we're talking about here. And the cyclically adjusted PE ratio was a design that was put together by Dr. Robert Shiller to help smooth out the volatility of valuation so there was a better correlation to long-term expected rates of return. Okay. But that doesn't mean in the short term that just because valuations, and this is where it's often misconstrued, people go, well, the Shiller PE ratio has been above 25 and the markets are still going up. Well, yeah, that's true. That is the case. Valuations are not a market timing indicator. What valuations simply tell you is what your expected rates of forward return is going to be. Not tomorrow, not next week, over 10 years, over 20 years. That's what it tells you it's going to be. So with stocks hovering at record highs here and valuations at the second highest level on record, the forward expected rates of return from current valuation levels is going to be low. But that doesn't mean, and this was a point that Dr. Shiller made today, is that in the short term, it doesn't mean that valuations can't go higher. Just because you're already at a very high level of valuations doesn't mean that those valuations can't go higher. And this is one of the misconceptions that's always brought up because I'm a big advocate of valuations. I talk about the risk of overvalued markets quite often, and people assume that simply because I talk about it, well, that I must not be invested, I must be sitting in cash waiting for the crash. And that's absolutely not the case. As we talked about just a moment ago, we were adding exposure with the recent breakout, even more, putting more equity risk in the markets. Why? Because the market trend is positive. The bullish sentiment is positive. We have a lot of margin debt in the markets, which margin debt and leverage increase the ability to push asset prices higher. Consumer confidence is high, and investor confidence is high, which is pushing asset prices higher. People right now have more exposure to stocks than ever before in history. That's pushing asset prices higher. There is no fear in the market. There is absolute complacency against a crisis in the market, which is good, and it induces market prices to go higher. So yes, that is why we have allocated more money to the markets, but doesn't mean we're not paying attention to the risk of the markets. But this is what Dr. Shiller said today. He said, Shiller said that Donald Trump's support for corporate America, which he says is driving sentiment, and market strength. The S&P index has climbed almost 9% this year, with the total return to investors running an annual rate of about 10%. It has something to do with our president, who is an exceptionally business-oriented president and who wants to deregulate and favors lower taxes. Now, remember, the Congress is trying to pass another tax reform bill that's going to further expand our deficit and increase more liquidity in the markets. That's the idea. Dr. Shiller goes on to say, he says, this has an effect on the market, but it goes beyond the rational, logical effect. It has something to do with our animal spirits. Again, sentiment, how we feel. The U.S. is doing great right now in terms of strength of the economy and the stock market. That seems to be built around the story at this point in history. He goes on to say, he says, valuations may be among the most extreme in long-term history, but they are still below the heady days of the technology boom of 44 times earnings at the turn of the century. The cyclically adjusted price-earnings ratio, which was popularized by Dr. Shiller, can go higher. And the point that he's making is that don't misunderstand the fact that because valuations are high, it doesn't mean that when you have a speculative boom going on in the markets, which we do right now. I mean, when you look at companies like Tilray, right? This marijuana stock came out at $20 in earnings just a couple of months ago. It's now like $150, right? It's just gone straight up. When you have that type of speculation in the market, it tells you that investors have become completely complacent to the risk of loss. And that means that they're willing to drive asset prices higher. Valuations can go a lot higher. This is Dr. Shiller's quote. The stock market could get a lot higher before it comes down. It's highly priced, but it could get much more highly priced. But, quote, it's a risky market right now. And he's absolutely right. It is risky. And as I'm writing for a blog post on Monday, I'll have this out. We're talking today about the components to make dynamite. And if you break down dynamite into its raw components, sand, nitrogen, glycerin, paper, all those individual ingredients really are pretty inert. However, when you combine them together and apply a process to them, well, you wind up with dynamite. But dynamite itself is fairly stable. Nitroglycerin wasn't so stable. But dynamite's pretty stable. And you can, as long as you store it properly, you really don't have a lot of danger. As long as it's stored properly, taken care of, kept dry, etc., you don't really have much of a worry with dynamite. Light the fuse accidentally or on purpose, and you have an issue. And that's the same way we have the market today. We have high valuations, which in and of itself is not an issue. High valuations beget higher valuations. Leverage is at near all-time highs, but higher leverage induces prices to go higher, which induces people to take on more leverage. Leverage begets leverage, which drives asset prices higher. Confidence begets more confidence, drives asset prices higher. So we have all these individual ingredients that are actually bullish for the market. As long as people are confident and they are complacent and they are not worried about risk and they've got capital to invest or leverage to access to put into the markets, asset prices can go higher, driving valuations higher. But all those ingredients, when put together, are the market dynamite. Because eventually, at some point, whatever that catalyst is, whatever lights that fuse that triggers a reversal in sentiment that leads to selling, eventually triggers margin calls, which forces more selling, which unwinds leverage, increasing more selling, which hits liquidity issues, which unravels the whole thing as the entire process collapses. And if you want a great look at how that occurs, go back and look at September the 15th of 2008. The market was already in a decline starting from earlier that year. And in September, when Lehman was forced into bankruptcy, Lehman wasn't the cause of the great financial crisis. They were simply the poster child of what the crisis was going to be because that fuse had already been lit. It was just the moment of the Lehman bankruptcy that the dynamite exploded and the margin calls came, the crisis occurred, people's sentiment changed, and it was no longer a buy the dip market. It was a get the hell out of the market. And that's what will eventually happen in the future. But that doesn't mean it's going to happen today. And it's not going to happen tomorrow or next week. Something has to change the sentiment of investors in the markets. Rising interest rates, emerging market crisis, who knows what it is. But at every point in history, we go back and look at 1929, 1974, 1969, 1965, 1987, 1999, 2007. Every point in history have all these same ingredients in common. Leverage, speculation, confidence. Stocks are at a new permanently high plateau, Dr. Irving Fisher said in 1929. The ingredients are always the same. The trigger is always the same. It's interest rates going higher. When interest rates rise, eventually you're going to hit a point to where something breaks in the credit market, the finance market, etc. Interest rates are going up. The short-term interest rate has risen dramatically. In 2 more rate hikes, the 10-year Treasury is going to be above the the Fed funds rate will be above the Treasury rate. And at every point in history, when Fed funds have increased at a level greater than the 10-year Treasury rate, you have had a recession, a crisis, market correction, or more. But again, that doesn't mean today or tomorrow. This is the point of the conversation, which is that Dr. Shiller is absolutely right, is that valuations are high. And they can certainly go higher because the bullish optimism in the markets is exuberantly bullish. And this is why we're invested in the markets. This is why our portfolios remain long the markets. But the reason I point out these other things is that we want to be aware that they exist so that at some point in the future, when we begin a turn, when we begin a change, when these things begin to evolve and prices began the initial slow decline, we want to be aware of it so we can make a change, so we can reduce the risk in our portfolios. We can protect our capital because as investors, that's what we're supposed to do. We can't buy low at the next major crisis point unless we have sold high to begin with. So managing money is our process. Managing money is what we're supposed to do as investors. And that's why Warren Buffett's number 1 rule is don't lose money. Number 2, refer to rule number 1. That's got to be your rules too. That's going to wrap up our show for the day. I'm your host, Lance Roberts. You're listening to the Lance Roberts Podcast. Be sure to get by our website. The newsletter will be out in the morning, so make sure you get that. Also, while you're at the website, make sure you subscribe to the newsletter. We'll email it to you. And we also email you a Technically Speaking update every Tuesday, so we keep you up to date on the markets, what we're doing with our portfolios. And of course, check out rapro.net. You can subscribe for free right now. It's got our actual portfolios that we're running. And, of course, we'll be updating those for our purchases this weekend. So all those will be on the website at realinvestmentadvice.com. I'm your host, Lance Roberts. Have a great weekend. See you back here on Monday at 3 for the next edition of the Lance Roberts Show. realinvestmentadvice.com.
Monday, always Sunday, in the rich man's world. All the things I could do if I had a little money. It's a rich man's world. It's a rich man's world.